So the second core benefit with a cash value life insurance policy is the liquidity. You have access to your cash value anytime you'd like. With whole life insurance policies, once I have cash value, I can access that money typically through a policy loan anytime that I'd like. If I start a policy, the earliest I can take a loan is typically 10 business days after I make the deposit. Does that always make sense? Not always when you look at the net growth rate, your internal rate of return, compared to the cost to borrow, but you can access the money. That's my point there. So in this video, we are going to focus on the liquidity and really break down how policy loans work. So when it comes to policy loans, what do we have here? They're available anytime, no penalties or anything like that if I want to access them, and there's no lost opportunity cost. What that means specifically is that once a dollar passes through your cash value in a policy, regardless if you let that dollar sit and grow, or if you elect to access the money, if you decide to take a loan against it, you will continue to receive dividends and interest on your entire bucket of money, your full cash value, as if you never touched it in the first place. So we're going to demonstrate that here. Let's pretend that you have a policy and you've got cash value of exactly $100,000. And for the sake of simplicity, we will assume that you are earning an annual internal rate of return of 4%. Our last video, we touched on the difference briefly between dividends and the internal rate of return. The internal rate of return is the net growth rate. For example, if you've got 100 grand in cash value, you don't touch it, 4% of that would come out to what? $4,000. So the next year, the cash value would be 104. Now, let's assume at the beginning of the year, before any of that 4% is applied to your 100 grand, you decide to take a policy loan. And the loan, let's make it a simple number here, is half of your cash value, $50,000. There is interest. Whatever that interest rate is, as the interest comes due, it is payable to the insurance company. Now, I can elect to pay it. I can also elect not to pay it. If you elect not to pay loan interest, what will happen is the policy will take a loan against itself, specifically from the cash value, and you'll see the death benefit reduced by that amount as well. But in this example, we're going to look at what the policy displays if we elect to pay that policy loan back. So we've got an interest rate here. Typically, you'll find interest rates with most insurance carriers between 4 to 5%. If it's an older product that had a guaranteed rate of 4%, most interest rates tend to fall between 5 and 6%. You can sometimes see them lower than 4%, depends on the company and product, but average range, typically right around 4%. So in this example, you take a direct policy loan, 50 grand, 4% cost to borrow, goes to the insurance company. Now, if I had $100,000, I elect to loan half of that. That means I have remaining equity, let's call it cash value equity remaining, of how much? $50,000. Meaning if I wanted to access more money, I've got another 50 grand I can pull. So here's my question. The 4% internal rate of return, if you didn't touch it, it was applied to the full $100,000. Now you took a policy loan of 50 grand. Is that 4% applied only to the remaining $50,000 that you have not touched, or still your full $100,000? The answer is still the full $100,000. With policy loans, there's no lost opportunity cost, and I continue to receive dividends and the guaranteed rate on my full cash value, any money remaining in equity, and also what is outstanding in policy loans. As a side note, if your policy is non-direct or direct recognition, that can have an impact on the internal rate of return and how those rates are credited, but you will generally see an internal rate of return, or dividends, let's call it, still applied on the full cash value balance, whatever you have in your policy. So let's look at some visuals here, because this is very appealing to a lot of people when we look at the second core benefit, the liquidity, combined with the first one. I've got that safe area to position money, net IRR between 3 to 5%, no matter what happens in the economy and market. Now I can leverage it to invest in other areas. Maybe it's in my business, maybe it's to pay off debt. but I can take this safe area, this safe bucket of money that continues to compound, and use it to enhance my overall net worth or my overall assets, if I want to look at it that way, because I've got this loan feature here. So let's take a look at some numbers, shall we? So here we've got a policy on a 40-year-old individual. We'll see over here his age, and at the end of the first year, he's 41. You'll notice if you've ever shopped multiple whole life insurance policies or insurance policies in general, if you're 40 years old, sometimes on the illustration, your age will be 40. It represents your age at the beginning of each year, and then sometimes it'll be your age at the end of each year. Why companies do it differently, who knows, but this starts out on a 40-year-old individual. That's my point here. So, pretty straightforward example. Funding a policy at $50K per year for 5 years and not a penny thereafter. So first and foremost, before we look at the loans, is this policy properly designed? Because the number one source of buyer's remorse is not how loans work with whole life insurance policies. It's, was the cash value maximized as I requested when I first started the policy or before I first started? So as we check off the boxes, the most important points, what do we see here? Annual outlay, $50K per year. First year, 50 goes in. Cash value, $46,000 and change. Cash-rich policy. This has a minimum base premium here. Death benefit, $1.1 million. Where we came up with that oddball number, I wish this was a clean $1 million, but a clean $1 million did not give us the MEC limit we wanted, or we want in this example. This has a MEC limit, which is that taxable line on a life insurance policy, of just over $50,000. So that is important to make sure that we keep the cash value tax-free. We want that third core benefit, the tax-free benefit, to remain intact all the way through. So we've got a minimum death benefit, or very close to it. Next year, we pay another $50,000. Death benefit remains intact. Eventually this will increase. We've got it set up level, really to illustrate how loans work. But year two, 50 goes in. We don't get the full 50 back. If we earned 0% that year on the internal rate of return, it would grow from 46 to 96. Yet we've got 94 and change. So our internal rate of return in year two is technically negative that year. Year three, I get my 50K back and a little bit more on top of it. Year five, I've now paid in a total of 250, and I have 250, 253 to be precise. That's my break even when I look at that point in time. Now, after that, I don't pay a penny into it. Here's the dividend column. Keep this in mind. This does not represent your total growth each year. And you can see this year 6. You pay in 0. The dividend payout, just about $5,700. Yet when we look at the growth, when we don't pay anything into it, year 6 to 7, it's about $11,000. So anytime you see a dividend column on a life insurance policy, or you get your dividend on your annual statement, that does not include the guaranteed rate that is included in your policy growth as well. Good to be aware of that. Let's look at loans now. Keep this column in mind though. Very important as we look at this example. We're going to look at the liquidity feature. $200,000 loan. This is how much we access. What is the gauge that determines how much we can borrow? Year 6, we've got $264,000. That is the equity you have access to. So we request a $200,000 loan. If we are relating it to equity, what does your line of credit drop to? $56,000. We make 0 payments whatsoever in year 6 because it's optional to repay it. What else do you notice? Look at your death benefit there. We took a $200,000 loan and our death benefit dropped by exactly $200,000. Anytime we take a loan, we will see that dollar for dollar reduction on the death benefit. Really, why that occurs is the death benefit is being held as collateral in the event that I die with a loan outstanding. So if I die with a loan outstanding, this is the net death benefit that is paid out to my beneficiaries. The trade-off, if I want to approach it this way, is that I continue to receive the same dividends and interest as if I never touched the money in the first place. Here's where you can see it. When we look at the dividend column here, year 6, $56.89. Over here, $56.89, where I never touched it. In this example, we start to pay it back at $30,000 per year. Here's our loan repayment. Now, we see that our loan balance does not drop by $30,000, drops by about $22,000. Here's the reason why. Do you remember what the loan interest rate was in this example? 4%. So, 4% of 200 grand is $8,000. We applied a $30,000 loan payment toward the policy. First, it was applied toward the interest. The rest went toward principal. That is why my balance is now $178,000. We continue to make $30,000 loan payments. We can pay it back however and whenever we want. Pay it off in full. And what do you notice here? By year 14, look at both sides. So the example where we loan and repay, what's your death benefit look like? Back to 1.1 million. What's your cash value look like? $366,000. What does it look like on the example where you never touched it? 366, 278. And we can repeat this pattern as often as we like. We can take additional loans while we have a loan outstanding. Functions like a line of credit. There's not multiple loans that are booked separately. It's one loan balance. This policy design, we can actually tweak it to improve the cash value growth. What we did for this example was just keep the death benefit level initially. And then once the term rider burns out, what you'll notice is that the death benefit begins to increase on both examples because they're identical. But the main thing here that you'll notice is anytime you take a loan, you continue to receive compounding on your entire bucket of money, your entire cash value, as if you never touched it in the first place. There's no lost opportunity cost. So having access to that money for opportunities is an appealing feature of a cash value life insurance policy. That's why we like to refer to it as one of the core benefits, the second one. So I hope you enjoyed this video. In the next video, we're going to take this a step further and associate internal rates of return and costs to borrow with it. We'll have some fun. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and we'll talk to you soon. Thank you again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.